Hello, good morning, and welcome to today's live technical analysis. Starting off with the euro against the US dollar. As you can see, it continues to validate our sideways moving motion, but it would need to test our support and resistance levels one more time before that is completely confirmed. But the narrowing of the Bollinger Bands may imply that it might actually move in a sideways fashion as we had predicted together at the previous session. So it appears to be moving in a sideways fashion, confined between S1 and R1, 1.0635 for R1 and 1.0460 for S1. This could easily change based on Fed Chair Powell's speech later on today. Note that on the 1st or 2nd of November is the FOMC's monetary policy decision meeting, on which they will decide whether to either cut, hold, or raise interest rates. About a week before, the Fed goes into its so called blackout period, where we have no more Fed speakers and essentially the markets are left to simply guess. Therefore, the speech by the Fed chair today may be important given that we may not see him speaking before that blackout period begins at the start of next week. So it might move in a sideways fashion as of now, but later on during the day, it could easily break above R1, break below S1, or it could even continue to move in a sideways fashion. Based on the comments made by Philadelphia Fed President Harker, he essentially hinted that the bank will be remaining on pause with their interest rates during their next monetary policy meeting. But he's not the only one who decides. It may be very interesting to see if there are further divisions within the Fed. Do we see more hikes or do we see a pause? I think personally that a rate cut at this point in time is far too optimistic and very unlikely. So, in my opinion, it's either a hold or a hike. Personally, I think they may need to hike one more time, but given the Fed's beige book, which came out yesterday, it's essentially implying that the loosening of the labor market may be making its way into the US economy, therefore potentially supporting the case for another pause. If the Fed chair today sounds hawkish or leans on the slightly hawkish side, we may see the dollar gaining against the euro, breaking below S1 and moving towards S2. On the other hand, should he sound slightly dovish, may see the euro gaining against the dollar, breaking above R1 and perhaps moving towards R2. If he refuses to comment or if he tries to perhaps mitigate the impact of any leaning, perhaps, so if he sounds slightly hawkish and then his next statements are perceived as slightly dovish in order to counterbalance his previous statement, may see it remaining between S1 and R1, hence why the distance between support and resistance is at this current level. It's approximately 181 pips, so we're giving it some time and some flexibility if it wishes to fluctuate between S1 and R1. Moving on to the crude oil, something that may be very interesting based on current market developments. We have three support levels and three resistance levels. Now, on a technical basis, as we were looking at this earlier on during the day, one could have said, look, it was validating an upwards moving trend line, the second from the same point. So perhaps we could have been maintaining a bullish outlook for the commodity. Well, you could put a few things from a fundamental level that may be impacting oil. On the one hand, you have Iran, who is asking for an oil embargo on Israel. Personally, I do not think that will happen, as supported by Reuters, who claim that some of their sources said that OPEC is not planning to meet or hold an emergency meeting anytime soon. And the group secretary general, which stated that OPEC is not a political group, therefore potentially easing fears that there may be an oil embargo on Israel and perhaps its Western allies. So, based on that, I would be going personally short on oil. Furthermore, the easing of sanctions on Venezuela appear to be increasing the supply of oil in the long run to the market. Therefore, despite it breaking above our resistance level at the $87 mark, it came back down, found heavy resistance at this point in time. Feel free to chart this yourselves so you can see what I'm talking about as well. Very close to R1, if not below R1 as well. Broke below our upwards moving trend line and now appears to be moving towards S1. At this point in time, it's also broken below the mid-range of the Bollinger Bands. Breaking below the mid-range may imply that this RSI is about to turn negative, turn towards 30. Breaking below 50, implying a switch from a bullish to a bearish market outlook. Now, for a bearish outlook to occur, I'd like to see it breaking below the 84.50 level and move towards the 81.70 level. If it fails to break below S1, I would switch to a neutral outlook, so moving sideways between S1 and R1. Whereas for a bullish outlook, which I do not think that is the case, but nonetheless should be stated, for a bullish outlook, it will need to break above R1 and move towards R2, breaking above this previous high in order for it to be validated as a bullish outlook. Simply breaking above R1 and remaining in between, and not forming a new higher high at the 88.50 and staying, let's say, for example, around here. Let's see if we can draw. Um, let's say it stops and then the new 4-hour candle moves and then comes around here at this arrow, right around here. It would still not be a bullish outlook. I would still maintain a neutral or even a bearish. For a bullish, it would need to break above a prior high, make a new swing high, however you'd like to call it, and move towards R2 90.40. It's already filled its breakaway gap nonetheless. So potential target S1 and then S2. We're going to be looking at gold. So the US 10-year Treasury bond yields are, if not at the 5%, 5% rate figure at this point in time. The US 30 bonds, 30 bond year, 30 bond yields are above 5%. So those are levels last seen in 2006, if I'm not mistaken, which paradoxically would have, under normal circumstances, led to gold to move lower. So why hasn't it? Well, let's look at the relationship beforehand. If the US bond yields are moving higher, given that they're interest bearing, then investors may seek to move away from gold and enter the bond yields markets as they provide a return, whereas gold does not. So why is it moving higher? Well, there are a few scenarios. A, you still have the increased geopolitical tensions in the Middle East. On a day-by-day basis, we're seeing increasing volatility. You're seeing statements yourselves coming from various nations, perhaps Lebanon, Egypt, the US, the UK. As a matter of fact, Prime Minister Rishi Sunak is visiting Israel at this point in time, start of a 2-day trip, if I'm not mistaken. You had US President Joe Biden, who visited yesterday. There's a lot of news surrounding this current conflict. So, based on that uncertainty and the potential risks, we're seeing gold move higher as well as the US bond yields. So, RSI is near 70, running along 70, 69.23, still validating our upwards moving trend line. So, we would be maintaining a bullish outlook for the precious metal. Now, R1, in my opinion, may be slightly higher. Maybe could be due to be brought slightly lower. The question is where. Let me just show you what I'm looking at as well. The black line is representing the current price at which the precious metal is currently trading at on our platform. And I'm taking this strong bearish candle. Came back down. Hasn't been tested recently. Strong selling motion at this point. So 1,975 for R1. We'd keep R2 at the 2020 level and R3 at the 2060. So 1,975, R2 2020, R3 2060 for S1. 1,932, S2 1,900, S3 1,865. We're also going to be looking at the dollar against the Japanese yen. So Japan's trade balance came in much better than was previously expected. As a matter of fact, their exports also grew 4.1 or 3.1%. I'll have to check that later, implying that the Japanese manufacturing industry who's exporting their goods has seen an increase in demand, at least for Japanese made products. In addition, the improvement in Japan's trade balance may be weakening the government's position for potential for another government intervention. It's currently testing our resistance level around 49.9, right on Q as well. Let's just see. Let's just make this slightly bigger so that you guys can see that at home. There we go. Look how it tried to break above, failed. It's still at above the mid range of the Bollinger Bands and is still moving higher. So how does this help potential analysts, let's say, looking at this? Well, one, you could say that the potential narrowing of the Bollinger Bands may imply lower market volatility, but in my opinion, based on a fundamental level and from a technical level, I would not be surprised if it breaks above R1 and then moves towards R2 before we see any potential government intervention. So why am I saying that? Well, earlier on during the day, we saw a comment saying that, excuse me, a comment by a government official hinting that the weaker Japanese yen may be aiding to Japan's increasing trade balance, which is something that is desirable for the Japanese economy. Therefore, based on that, we may see a reluctance on their part to actually intervene in the markets, which would have appreciated the Japanese yen against the US dollar, simply bringing our two levels slightly lower, 151.45. This would be my resistance level for R2. So if it breaks above R1, expect it to move towards R2, and then I would expect a government intervention to occur at around R2. But that is purely speculation at this point in time. No, that is moving in upwards fashion, validating our upwards moving trend line. Appears to be a wedge as well, breaking above. A small market correction back to R1 to test that it's actually resistance turned support before moving towards R2. Now, given that it's moved higher, I think it's also prudent that we move our support levels as well. We're going to give it some space, however, we're not going to be bringing it as high. Let's just zoom in so that you can see. So we could have brought it at this previous high here, but it would have been too close to R1, and I'd like to give it some room to breathe. I like in case of a fluctuation or a market correction over, I wouldn't want my support level to be around here. If it's here, then it's still far too close. Here, even closer. So what I do is I bring it at around here. So why am I using these four blocks instead of this prior higher low? Well, I think there's more of a substance at this point in time. It's also coinciding with this wick, which I personally thought was a small government intervention to test the waters for another intervention, as was this move here, as we're assuming this move was here. They still have not released anything, so speculation once again. Let's just line this up, 148.87. This would be my S1. Be keeping S2 and S3 as well, as they were previously. Just zoom out. Much better. 148.7, 147.4, 146.2, S1, S2, S3, R1, R2, and R3. Slightly bullish on the pair, validated by the RSI. On the daily, it appears to be moving upwards as well. So this would be an interesting pair to continue watching tomorrow as well as we comes to a close. Note that Japan CPI rates are due to be released tomorrow, so those could potentially impact the currency pair. The British pound against the US dollar. R1, it's moving in this yellow box that we've defined. It's broken above. I think it's actually moving to test support at the 1.2065 level. I don't think it's going to be moving in a downward fashion. Personally, I think it's going to move sideways up until Fed Chair Powell's comments later on today. Why do we keep saying up until Fed Chair Powell's comments? And you've probably heard that from other sources as well. Well, given that he's essentially he is the head of the Federal Reserve of the United States of America. Any comments he made or makes may have a significant impact on the market. So sideways fashion up until the speech. From then onwards, it's anybody's guess as to what he's going to say. But I think he may lean towards a slightly hawkish rhetoric, despite Philadelphia's Fed President Harker's comments yesterday, which could have been perceived as slightly dovish. I still think that the US has some way to go with battling inflation, so may warrant another rate hike or a hawkish pause, which is essentially we're remaining on pause now, but may hike in the future. We're going to be looking at what else today. We can look at AT&T, who is due to release their earnings later on today. We're also been looking at Tesla's, whose earnings came in lower than expected, which is why it's moving in a downwards fashion. We'll fix our technical analysis later on, but for now, let's look at AT&T, whose earnings are due out today. Tesla, there we go. AT&T. Let's remove the grid. There we go. 4-hour time frame. We had this gap that was filled, another gap that was filled once again. Let's point this out as well. Need to place that one more time. There we go. Hasn't been touched or filled yet, so this is a gap that may be filled at a future point in time. Let's just place our support and resistance levels. We can see support at 14.25. Actually, 14.24, more appropriate. 14.24 for S1. Let's look for S2 as well. 13.85. I think that is a fair move as well. Okay, so that could be S2, and then for S3, we could have 13.4. For R1, we have two options. One, we could take at the beginning of this gap that exists, so this could be R1. It's fairly narrow though, so I'd give it some space as well, coinciding with the upper range of this breakaway gap. 14.75. 14.74 it is. I want to coincide with the upper range. Then we're going to be placing R2 higher than that. Means we're going to be reevaluating our support levels as well. 15.60. And given that they have earnings, I think that is actually more prudent. I'm removing S2 immediately. And then for R3, $16.85. This could be my R3. Enough space between them as well. If it vastly exceeds expectations in terms of earnings, I would not be surprised if it breaks up above R1 and R2. That's why we're placing R3 slightly higher than the rest in the event that happens. Whereas lower than expected, breaking below S1, moving towards S2. But if it comes in much lower than what we were expecting, then that scenario changes. Don't have enough data, so we're going to be estimating a potential support level. So you have 14.24, 13.4, and then the difference is zero point 0.2, so we can go 12.20. Slightly bigger as well. And we have S1, S2, and S3. We're also going to be looking at Tesla, the technical analysis as well. And why are we looking at Tesla? Where their earnings came in lower than expected yesterday, which has resulted in the stock moving lower. So that may be interesting to you. And we're going to be looking at Tesla we had before. There we go. Tesla R1 validated, failed to break above, moved below. Now it's aiming to test support at 234.0. Then the next level of support would be at 198 and then 165. So you have S1, S2, S3, R1, R2, R3. The earnings report came in lower than expected. So perhaps maintaining a bearish outlook for the company's stock price. Note that the RSI as well is moving towards 30, implying a strong bearish market sentiment. One could say this could be moving in a sideways fashion, and they would not be wrong in part. And why am I saying in part? Well, you have the Bollinger Bands which have narrowed, implying low market volatility. But based on the fact that the earnings came in lower than expected, we may see continuation of a downwards fashion up until S2, or perhaps between S1 and S2, not a sideways fashion. For a sideways fashion, though, if it does occur, failing to break below S1 and staying between S1 and R1. Note that it was moving in an upwards trajectory for breaking down and moving lower. Also be the start of a downwards moving trend line or even a downwards moving channel, but for that we would need more information. So maintaining a bearish outlook for Tesla. And AT&T, at the end of the day, we actually need to add some indicators as well. Let's add the Bollinger Bands. Extreme narrowing, but failed to break above the mid-range. For me, from a technical basis, appearing to be bearish. Let's just add our RSI indicator as well. So you can see what we have. Average range, ATR, volumes, and then you can have anything you want essentially. We've added the Bollinger Bands. Perhaps we could add true range as well. And then let's just add a RSI one more time. 30, 50, and 70. So ATR and RSI are supporting a bearish hypothesis as well. So I would be maintaining a bearish outlook on a technical basis, but that is due to change depending on their earnings. And we're looking at a few more Forex pairs. Let's see. The Australian dollar. So why are we looking at the Aussie today? Australia's employment data came in during today's Asian session. The earnings data was mixed. On the one hand, you have lower than expected employment change, but then you have lower unemployment rate. So, which is the heavyweight of the two? That remains to be seen. On the daily, it appears to be moving in a downwards fashion, potentially driven by the US dollar. It may have ceded some of its control. We're going to be keeping our support and resistance levels as they were before, 0.6285, S2 at 0.6165, S3 0.6070, R1 0.64, R2 0.651, R3 0.6605. So are we keeping it this way? Well, it hasn't given us a reason as to why we should change them. Narrowing of the Bollinger Bands, no market volatility. Wasn't moving in an upwards fashion as it broke below our upwards moving trend line, aiming for support at 1.06285. If it does break below S1, then yes, it may warrant a recalibration of our support and resistance levels. But for now, simply put, there's no need. S1 as a support base. If it breaks below S1, potentially moving towards S2. The RSI is near 30. It's at 36 at this point in time as well, implying a bearish market sentiment. But how strong will the dollar be? The mixed employment data from Australia raises a few questions. Well, one, if you have an employment rate decreasing, then I'd place personally more weight on that than the employment change, as the unemployment rate is the unemployment rate. Could warrant another hike by the RBA. So, should they be tending or nearing towards a hike, we may see the Aussie gaining. On the other hand, the mixed employment data could warrant a pause, right? Gaining more data before deciding whether or not to cut or hike or remaining on pause for a further time period. It appears to be weighing slightly on the Aussie though, which I would attribute predominantly to dollar strength. As you can see, the British pound losing against the dollar slightly. Still, it is still losing. The euro appears to be holding its own against the dollar, but the dollar against the Japanese yen moving in upwards fashion. So overall, a slight strengthening of the US dollar. So for now, I'd be maintaining a sideways fashion as well, unless it breaks below S1. If it breaks below S1, I would be switching to a bearish outlook, moving towards S2. Now, on the other hand, for a bullish outlook, it would need to break above R1, although that does not appear to be the case at this point in time. Once again, this pair, given that it's denominated in US dollars, could also be impacted by Fed Chair Powell's speech later on today. But let's ignore all of that. Let's move on to China. Australia is heavily reliant on China for its goods. Essentially, the Australian economy needs the Chinese economy to import Australian goods. So, if China's economic woes continue, and if you simply Google Country Garden, you'll see what we're talking about. One of the largest property developers in China failing to repay a $15 million coupon bond during yesterday's trading session, if I'm not mistaken, is causing worries around the markets. Why? Property developers moving lower. Note with the report from a news outlet, which I can't remember at this point in time, last week, which stated that there was a perceived bank run in one of the Chinese banks, could be fueling market worries about China's economic recovery. So if the Chinese economy moves in a downwards fashion, then it would make sense that the Aussie would also be weakened despite any gains in their domestic economy. They're over reliant on China. We've been saying this for many months now. And given that it's continuing, they may be heavily impacted by news stemming from China. So, from a more macro level, the Australian dollar could be moving in a downwards fashion. Let's look at the weekly. On a weekly basis, we have 3 weeks in the reds for the Australian dollar against the US dollar, breaking below, and appears not to be stopping. RSI is near 30, so it could break below S1 and actually move towards RS2 figure on a weekly basis as well. So not only is our 4-hour time frame validating a bearish outlook potentially, it's on the weekly. So based on what I said before, I'm going to be retracting my statement and maintaining a bearish outlook for the pair for a more macro level as well. Why? We're seeing it on a weekly, we're seeing it on the 4-hour as well slightly. I think it's about to break S1, but we may be wrong. And what else are we going to look at? We could look at perhaps look at Apple, Intel, Google, or we could look at the dollar against the Canadian dollar. Goes to say one more time as to why it appears that it is dollar strength, not Aussie weakness, but it could be also some Aussie weakness as well. We're seeing that the dollar is appreciating against its counterpart, so this is support now turn resistance. Just quickly through them. This becomes S1. 0 0, and then turning this text label from green to red. S1 prior now becomes S2 new. And let's just make this support line slightly larger. S3, as prior S2 now becomes S3. Go. Then let's remove our prior levels. And now we're going to be looking or hunting, if you'd like, for our resistance level at R3. Which we do not have. Scratch that. Yes, we do. Right here. So let's zoom in. So at the back, look how neatly these two candles line up. Strong bullish market sentiment, then bearish. Found heavy resistance at this point in time, validated by the fact that they both essentially closed for the bullish and opened for the bearish candle near or around the same point. So I'd expect heavy resistance to be met at this point in time for any bulls at this point in particular. 1.3920. So that would be my resistance level for R3. And then simply let's change this. So I have R3, R2, and R1. Then we have R2, 1.3860, R1, 1.3785. We could even see an upwards moving trend line at this point would be far too steep for my liking. Simply put, far too steep. Maybe due market correction lower as well. So that would be interesting to see. One could have said this was moving in a sideways fashion before breaking above our resistance now turn support. So for now, we're maintaining a bullish outlook for the pair. Our signer 70 broken above resistance now turn support, aiming for the 1.3785 level. And I think we have time for one more. Or we could look at perhaps something that might be interesting. Facebook, Google, Goldman Sachs. Goldman Sachs, whose earnings were lower than expected, moving in a downwards fashion. We noted this gap that exists. At some point, this might be filled. This was filled, so we're going to be ignoring that. So for Goldman Sachs, simply put, it's broken below that level too. Perhaps removing this entirely. And then finding S3, which I would be placing around here. 264.15 for support level S3. It's too close to S2, so let's take this previous high. 260.10. Okay. We've given it some space, and then actually S1 might need to be brought slightly higher. But this is a valid point. I'd rather take this point run rather than bring it around, let's say, here, which is where it's actually at right now. Look, a small intermediary support level could be at around here, 297.5. If it breaks below, moving towards S1. But from a more macro perspective, in terms of an actual support and resistance level, support 289.10, S2 275.05, S3 260.10, R1 317.95, R2 333.55, and then R3 344.40. This was R2. Slight sideways, but I'd still maintain a bearish outlook given the running support were below what was expected, perhaps moving towards S1 before correcting and moving between S1 and R1. And with that, that does it for today. Thank you for watching.
Hello everyone, my name is Emily and welcome to another video. Today we're going to talk about automated trading systems. Automated trading systems, also referred to as algorithm trading, involves the use of an algorithm to execute trades according to the predetermined criteria. The systems allow traders to establish specific rules for both trade entries and exits. Once these are programmed, they can be automatically executed by a computer. The benefits of automated trading include more trading uptime, minimizing the impact of emotions during the trading process, and faster execution. To get started with automated trading systems, you need to decide whether you want to build your own system or use a third-party algorithm. If you build your own system, you can choose every aspect of the strategy and have a better understanding of how the system works. It could open and close trades based on timing or price using technical indicators to confirm your entry and exit points. For example, you could build a system to automatically buy 100 Netflix shares when its 50-day moving average goes above the 200-day average. Or you can automatically sell 100 Netflix shares if the market reaches volatility levels you are not happy with. If you are not confident enough to build your own system, you can use a third-party solution instead. This works in a similar way to a self-built system, opening and closing trades according to set criteria. However, you will have less control over the customization of these parameters. Whether you build your own automated system or use one which has been pre-built, it's important to backtest it thoroughly to make sure it works in the way you want before you put it to work on the live markets. MT4 is popular if you want a third-party solution because MT4 provides a marketplace where you can conveniently access pre-built algorithms to get started with automated trading. It's important to note, though, that automated trading systems have some downfalls that you should be aware of, like the possibility of mechanical failures. For instance, if an internet connection is lost, an order might not be sent to the market. Automated trading systems need to be monitored because of the potential for technology failures, such as connectivity issues, power losses, or computer crashes. Automated trading system can experience anomalies which could result in wrong orders, missing orders, or duplicate orders. If the system is monitored, then situations like this can be identified and resolved quickly. Thank you so much for watching us today, guys. Bye-bye.
So first, today we're going to be talking about preparing for earnings season. We're just going to go through a couple of tips and what this means for you as a trader. Okay, before we get started, as per usual, we're just going to go through the risk warning and disclaimer. So our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So our disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, hi everyone, I'm Melanie and I will be your speaker for today. I'm an investment analyst from the company Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, so here is our agenda for today. Firstly, we'll briefly talk about what exactly US earnings season is and what we should do to or what specifically we should watch out for, and how we can trade them. And we'll also go through some risk management strategies as well. Okay, so what is the US earnings season? The earnings season is the period of time during which a large number of publicly traded companies release their quarterly earning reports. So in general, each earnings season begins 1 or 2 weeks after the last month of each quarter. So December, March, June, and September. So what does this mean for investors? So this is basically a very active time in the market, as participants such as yourselves, analysts, traders, investors, review the earnings reports, which may affect their positions on or in a company. You can often see a lot of movement in the shares of companies releasing reports as the market reacts to the new data. So it is not unheard of to see shares jump 20% or more to see them fall by the same amount. So it's also a highly active time for the financial news media, such as CNBC and the Wall Street Journal. There is extensive media coverage of the major earnings releases, from a general recap of the earnings to a report on whether the companies missed, met, or beat analyst expectations. So some traders look forward to the earnings season, as it can be a period where they confirm the positions they have placed. For example, shorting a stock before earnings and watching the price drop can be beneficial, as the psychological drop will usually trigger a sell-off. Conversely, a ramping up in production or revenue could result in a swift upward trajectory or stock price. So other investors sit out the season entirely, as there are too many human factors at play. So there's just some things for you to take note of as well. So for this year, July 2023, the second quarter earnings season has begun in earnest during the second full week of July, led by banking giants JP Morgan, Chase, Wells Fargo, and Citigroup. Analysts at US financial data group FactSet estimate an earnings decline of negative 7.1% for the S&P 500 companies, which will mark the largest earnings decline reported by the index since the second quarter of 2020. Okay, so this is the update or the current situation that we are facing. What exactly can you do to, as we await more earnings report releases? So these are just 3 tips or 3 things that you can keep a lookout for. So firstly would be the performance of bellwether stocks. Second, earnings recession, as well as thirdly, the earnings and stock index weighting. So there are a number of factors that you can look out for in companies' earnings reports, but traders should be the most mindful of performance of the largest bellwether stocks, as well as understand the significance of an earnings recession in a given stock and grasp how a stock's earnings announcement might impact a relevant index depending on the weighting of the given security. So we might go and look into DXY as well later on after we are done with our slides. Okay, so let's get into it. Firstly, we have performance of bellwether stocks. So some examples of bellwether stocks would be FedEx, which most of us are familiar with. It's a shipment company for consumers as well as businesses internationally. Next, Caterpillar is the world's largest heavy-duty machinery maker. It's viewed as bellwether given that it has a large exposure to construction, manufacturing, and agricultural industries, particularly in China. 3M, gauge for the health of the manufacturing sector, as well as Apple, which we are all familiar with. So when analyzing company earnings, it's important to look out for these stocks similar to these, because it can be seen as a gauge of the performance of the macroeconomy. So while the status of a bellwether stock can change over time, the largest and most established companies are typically considered a bellwether stock. So these are the examples that we've given, but of course there are others as well. Okay, next we have, we should look out for the earnings recession. So what exactly is the earnings recession? It's basically categorized as 2 consecutive quarters of year-on-year declines in company profits. So it's important to note that while earnings are an important factor in the stock market returns over the long term, an earnings recession does not necessarily coincide with an economic recession. So the chart that I've included here from Thomson Reuters data stream shows that in the past 6 earnings recessions witnessed in the US, only 2 had coincided with an economic recession. So the blue circles that you see here show where there was an earnings recession without an economic recession. while the red circles represent where both earnings and economic recession occurred simultaneously. Okay, next we have the earnings and stock index weighting. So traders should understand that when trading earnings, certain stocks will have a greater impact on the wider index according to their index weighting. So the example that I have here is when trading the Dow Jones. Boeing releasing its earnings will be highly influential on the index, while Visa likely won't be as influential. Why? Because of its former's 9.49% weighting compared to the latter's 4.1%, which you can see in this table that I got from dailyfx.com. So this really highlights the importance of paying close attention to bellwether stocks and how they may impact a broader equity index. Okay, so how exactly are we going to trade using all of the information that we have? So we've simplified it into 3 simple steps. Firstly is to select a specific company to focus on, or set of companies. Secondly would be to do your research, and thirdly would be to formulate a trading strategy and follow it. So firstly, choose companies to focus on. This is pretty straightforward. It's advisable for traders to go for a small number of companies, perhaps stocks that you are already familiar with or trade already, and find the dates on which their earnings will be released. So large bellwether stocks are worth investigating whether one is trading them or not, as the impact of their results can impact wider industries as well. So when you're deciding on the stocks to go for, traders should understand that the relationship between an earnings result and subsequent price reaction is not always straightforward. So for example, if there are better than expected earnings, that normally indicates a bullish bias, but it does not always translate to immediate price gains, and the opposite holds true as well. So the example I have here from DailyFX as well is Walmart's strong earnings in the third quarter of 2013 or 2018. And this is failing to excite market participants. So while encouraging, a quarterly report is more than last quarter's results compared to expectations. So analysts are often much more concerned with the future expectations of the firm, as price is a forward-looking metric, with future earnings being calculated in current prices. So if we think about it that way, then it becomes much more reasonable when investors like yourselves perhaps shy away from a stock with strong results for the past quarter, but an abysmal outlook for the future. So weaker outlook can seriously undercut a stock's current valuation as well, regardless of past performance. Okay. Next, we have doing your research. So this ties nicely with our fundamentals analysis as well. So doing your stock research properly will involve looking at estimated earnings for your chosen stock. It also involves comparing these earnings with the analyst's expectations. Traders should also make sure that they look at historical figures to get a feel for how the market has responded to releases in the past. So while earnings season is typically thought of in terms of what the results mean for a single stock, the season as a whole can also offer important takeaways. So one such takeaway is information is offered on a company-specific basis, but common themes can ring true throughout. So one such headwind would be our recent coronavirus, or perhaps geopolitical tension in specific areas. So these can combine to form a wave of worries across all sectors or specific sectors, if the impact is big enough. So traders should investigate how such headwinds impact on one sector or stock compared to the others. So another example would be perhaps many industries suffered greatly during our pandemic, but March 2020 saw Greece-based tanker vessel operator Topships Inc. experience a surge in product demand in areas such as cleaning supplies as well as paper products, leading to increased shipping requirements. So this in turn created higher trading volume and volatility. Okay. Lastly, formulating a trading strategy and following it. So formulating a trading strategy for earnings season should include a methodology for entry and exits, profit goals, time spent trading, and a risk management plan. Trading earnings reports is typically difficult and risky. So for some, trading around the event may not suit their risk profile. And so any position taken should be adequately hedged and definitely include a stop loss. So with that said, volatility can of course also create unique circumstances. So it can also provide opportunities for a few specific strategies as well. Okay, when formulating a strategy for earnings season, traders should be aware that quarterly earnings are capable of seriously uprooting an ongoing price trend due to their relative infrequency and importance. So this often causes traders to position for severe price swings, evidenced by heightened implied volatility. So we'll go through a couple of stop loss strategies or risk management strategies that you can implement into your trading strategy as well. And these are not specific to only earnings season or stocks, but of course, for Forex or your commodities as well. Okay, so firstly, we have the most basic, which is proper stop loss and take profit placement. So proper stop loss and take profit placement is crucial to ensure that you maximize your wins and minimize your losses. So for stop loss, it should be placed beyond the resistance area, while take profit should be placed before. Okay, here is just an example for you to look at as well. Okay. Here we have trade management with confluence. The confluence that we're talking about in this case is referring to Fibonacci confluence. But if you have a couple of support levels lining up, resistance levels, those are considered confluence as well. So firstly, stop loss should be placed beyond, as we saw earlier. And this basically means that you should always put your stop loss beyond a key Fibonacci confluence area. So the reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence. And if your stop loss is right before, instead of beyond it, you will most likely get stopped out before the market reverses. Okay, as for take profit, we always recommend to place it before a key confluence area. And the reason for that is because when price reaches a confluence area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry instead. Or even worse, your stop loss. This is also one of the reasons why people complain that the market is being manipulated, because they miss their take profit by 1 or 2 pips. Okay, now we take a look at a couple of dynamic take profit placement examples, just to show you guys a couple of real life price examples. Okay, so here we have a negative 27.2% Fibonacci expansion that lines up nicely with the 127.2% Fibonacci extension. Okay, you can see this over here at this blue highlighted area. So that's where we've placed our take profit. And as for our entry, we've placed it at this overlap area. So an overlap resistance in this case basically means that you have a swing low that lines up nicely with a swing high. Okay, so our entry is a pretty strong level since price has tested it many times before. And then our stop loss is just at this swing low here. So the take profit, we've placed it above the confluence area. And you can see when price moved up, okay, this is the before, right? We're expecting price to bounce off of the entry and hit towards our take profit. But in this case, we placed our take profit before the confluence area. And you can see it reversed off and it missed our take profit by a couple of pips. Okay, it did exactly what we expected it to do, but it reversed off because of the strong resistance area over here. So in this example, we place the take profit under it instead or below the confluence area. And you can see price hits our take profit nicely before reversing back down to our entry. Okay, so that's just one example of a risk management strategy. The next example we're going to be talking about is break even. So just really quickly, because this is not a risk management webinar, but we're just giving you some examples of how you can implement this into your trading strategy for earnings season as well. So break even is a level where you are in profit and recognize that there's a risk of a reversal back to your entry. So it's basically you saying, if I'm right, price should go all the way to my target, but if it goes back to entry and you are wrong, then you should get out. So firstly, we have our entry. So our entry is over here at this blue dotted line right over here. So we go in for a buy at this double swing high resistance. So it goes up and then it fluctuates a little bit, and then instead of shooting up towards our take profit, which is represented by this green area here, instead of going all the way up, it actually reversed down. So when it reversed down, this specific area here at this swing high, level is our break even. And it's our break even because we see price reverse back down. So we panic and then we put our stop loss originally is here, but because it reversed over here, we want to place our stop loss over here instead. Okay, and then it reversed off, it hit it back up, and we think maybe there's a possibility that price is gonna hit our take profit here, but it doesn't. It reverses down and you get stopped out here. But it's fine because even though price you've been stopped out, but you still you didn't make a loss in this case. Okay, I hope that was clear what exactly a break even is. Okay, next example we want to talk about really briefly is idea invalidation. So idea invalidation is usually placed before your stop loss. It's the level at which you basically admit, I'm wrong, let me get out ASAP. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So in this example, once again, we are entering from here at this level here with the two swing highs, and then price reverses down and we expect price to continue downwards to hit our take profit. but it doesn't, and it reverses and hits back up. So it hits back up and it even surpasses our entry, continues upwards, and then our original stop loss line was here. But instead of moving our stop loss in this case, we add an we move our take profit instead. Okay, so what we mean by this level, the purple level, is our ideal invalidation level, is that it's basically at this point where we realize that we want to get out of the trade. Okay, so it reverses off and it hits our take profit nicely. Okay, but if we didn't modify our take profit and we just left it over here, it would have reversed and shot back up and hit our stop loss instead. So we got out here at break even before price rose further and stopped us out. So ideal invalidation involves moving the take profit, whereas break even, as we saw earlier, involves moving our stop loss line. Okay, I hope that was clear. We go more in depth into the different kinds of risk management techniques in our risk management webinar series. So you can stay tuned for that if you've missed those before. But yeah, this is just a brief run through of some of the techniques that we use. Okay, so just a bonus slide, some tips for you to take note of is to firstly know the expected results. So keep up to date with the releases. Secondly, stay alert to surprise announcements from the respective companies. Thirdly, be aware of spillover effects between stocks, since especially for stocks within the same industry, a release of one stock can definitely impact the earnings report of another. Next, consider volatility over the bearing of an expected move. So you should definitely be aware of what the expected number is, as we mentioned earlier, and then be careful, or rather take note of whatever volatility that follows the release of the earnings reports. Okay, and that is all for our slides. Now we're just gonna get into some of the setups for this week. So we have a request for Brent oil. I think we'll look at DXY as well, since we're talking about the US earnings report as well. Okay. So we'll do Brent oil first. And if there are any other requests, let me know in the chat. Okay. Okay, let me just check to see if you guys can see my chart. Okay, all good. Okay, let's get into it. So as per usual, we want to look at the higher time frames first, just so we get an idea of where prices are headed. So the general direction is pretty bearish on a weekly time frame, and on our daily time frame as well. Let me see if we have a trend channel on our okay, price is moving in this, or rather price has broken out of this descending trend channel on our daily time frame. Okay, so this gives us a bit of a bullish bias. So let's take a look at this on our 4-hour time frame. Okay, it's pretty bullish as well on the 4-hour time frame. Okay, no trend channel. Let's see if we have a trend line. Okay, yeah. So remember, for a valid trend line, there has to be minimum 3 touches on the trend line. In this case, we definitely have 3. Okay, so let's get into our support and resistance levels. Okay, so for my first resistance, I'm going to place it at the closest swing high to where price is currently at, and I'm going to try and pull it all the way back as far as I can without cutting too many candlesticks. Okay. And then first support level will be over here. Second support maybe here. And second resistance here. Okay, now that we have these levels, I'm going to go in with some Fibonacci levels. So for a Fibonacci retracement, which is what I'm looking for here, we use these 5 levels. So I can see my 78.6 lines up nicely with my first resistance. Yeah, that's all. Next, I'm looking for a projection. So for Fibonacci projection, we use these 3 levels. And I can see my 100% lines up nicely with my second support. Okay, my 61.8 also lines up with my first support. And I'm looking for another retracement here. Okay, and my 38.2 lines up with my first support as well. Okay. Okay, I'm just looking for a extension here. Okay, and my 16. So for Fibonacci extension, we use these 2 levels, 161.8 and 127.2. And my 161.8 lines up with my first resistance. So you can see that I already have this huge area of resistance here because I have so many levels that line up. Okay, another thing, if you guys are wondering what exactly is a Fibonacci extension, it's basically when we call it the Nike tick. retracement. So when you have a shape like this, or perhaps if it's inverted, it will be like that. Once it has retraced 100% of the head, then you can use this method, and it's to project where prices are going to bounce off of. So it bounced off of the 161.8, as we can see here. And earlier I used the 127 as well, but it was over here, so it didn't have any effect. Okay, that's for extension. Let's see if we have anything else. Okay, okay, no. Okay, that's all the Fibonacci levels that we have here. So we can see this huge confluence area here is what is pushing price downwards, but it's not likely to, or rather we don't see any signs of price breaking out of this ascending trend line. So even though it is a bit bearish over here, we can expect it to head towards maybe this our first support level here, but probably no further than that. Why? Because of this ascending trend line, but also because we have the 61.8 and also the 38.2 Fibonacci retracement. Okay, so now let's pull in some indicators to support this. So Ichimoku price is moving above the Ichimoku cloud, giving us a bullish bias. MACD is also giving us a bullish. Okay, I accidentally clicked on the SMA, but it does look like price is breaking out of it. So it's breaking out of our moving average, and it appears to be moving below it instead. So it's giving us a bit of a bearish bias. Okay, and then over here we have a bit of a bearish divergence as well. So price is making a higher high on our price chart, and price is making a little bit of a lower high on our RSI. Okay, so I'm going to go ahead and remove Ichimoku and MACD because it doesn't support our analysis. Okay, yeah, I'll definitely look into gold as well. Okay, so here is our analysis for Brent. So we're expected to drop from the first resistance towards our first support, but probably no more than that because of the confluence and because of the trend line. Okay, next, let's take a look at gold. Okay, same thing, we're gonna look at the weekly time frame first. Prices are pretty, okay, it looks like prices are headed upwards, quite bullish over here. We have 3 swing highs, but apart from that, nothing else. Okay, here's our daily time frame. Okay, we have an ascending trend line here. Okay, let's see. So pretty bullish on both the weekly as well as the daily time frames. Okay, let's take a look at the 4 hours as well. It looks like prices just broke out of our descending trend channel on the 4-hour time frame. Let's see if we have a channel here as well. Okay, no. Okay. So we don't have any channels or trend lines, so we'll just go ahead and start off with our support and resistance levels. So here's my first resistance, closest swing high to where price is currently at, and then swing support level is at the closest swing low. Okay, I'm just gonna highlight this level as my intermediate support level. Why? Because we have seen that price has tested this level many times. Okay. Yeah. Okay. So we're likely seeing a buy towards our first resistance over here. Okay, let's see if we have any Fibonacci levels. Okay, are my 23.6 and 38.2 line up nicely? And okay, my 78.6 Fibonacci projection also lines up with my first resistance. Okay, my 50% lines up. Okay, what else? Okay, I think that's it. So now that we have these levels, let's go in and look at some indicators. Okay. Ichimoku isn't really telling us anything now because it's moving within a cloud. But it does look like it's breaking out and moving above, but only when it's moving above, then we can confirm that it's bullish. As of right now, MACD is also bullish. RSI. Okay, we have another divergence over here. Okay, price has made a higher low. Whereas on our RSI, it's made a lower low. So we could be seeing price continue to drop because this is a bearish divergence here. Okay, but on our SMA, it's moving above the line as well. Okay, so in this case, we can probably expect price to continue to go up towards our first resistance here. Because of all the upward pressure we've seen on the daily and weekly timeframes that prices are pretty bullish, and we want to trade. We normally like to follow the general direction of price. And on our SMA, we can see price is bullish on our MACD as well. But our RSI doesn't support our analysis, so I'll just remove that. And then we can also keep an eye out on our Ichimoku indicator as well, because it does look like price is breaking out over here. Okay, and then with all of this support area here with the multiple swing highs, the 23.6, we are not expecting prices to continue to drop to this level. It's likely to continue to push it up towards our first resistance. And our first resistance also is a pretty significant level with all the swing highs as well as the retracement level. So it's likely to attract price towards that area. Okay, that's all for gold. I think we have time for maybe one more chart. So if there are any requests, feel free to let me know in the chat. You're fine. Okay, sure. Okay, weekly time frame, it's pretty bullish, bearish, as you can see. Okay, daily time frame, pretty bearish as well. Okay, on our 4-hour time frame, definitely bearish as well. Okay, let's go ahead and add some support levels. Okay, now let's see if we have any channels. Okay, I don't think so. Trend lines, maybe. Okay. So we have our first support. Let's go in with another level. I have a resistance here, first resistance. Okay, it's a bit hard to analyze on this chart because there are no previous levels for us to take note of. So we're just gonna jump right into our Fibonacci levels. Okay, so earlier I mentioned Fibonacci extension. So we're going to take a look at okay, I have my first resistance here. Okay, my projection level lines up nicely, as well as my 100%. Yeah, I'll maybe get rid of this intermediate support. So I remove my 127 as well. Okay, let's see if we have any other levels. Okay, I think this level over here will be my second resistance. Okay, in line with the 78.6 and also the swing low over here. Okay, I'm gonna add my first support over here. And then this will be my second support, just because it's a bit closer to where price is currently at. Okay, now let's go in with some indicators. I'm pretty sure everything will be bearish. So we have price moving below the Ichimoku cloud, bearish and bearish as well. Let's take a look at RSI. Okay, all pretty bearish as well. Okay, so we can expect price to continue moving downwards towards our first support because of all of the downward pressure from this descending trend line. Excuse me, from this let me highlight it, this resistance area, because of the confluence area as well, 61.8 Fibonacci projection and also the 161.8 Fibonacci extension. So we have that, and also our indicators all giving us very bearish signals, so we can expect it to continue to drop to our first support. Okay, that's all the time I have for today. I hope you guys found it helpful and learned something today, and I will see you guys next week. Thank you guys. Have a great rest of your week. Bye. Thanks, Fan. Thanks, Yuha. Bye. See you guys next week.